investment advisor of the fund has the day-to-day responsibility for managing the assets within the portfolio. The investment advisor must, of course, follow the investment objective of the fund. The initial advisory contract must be in writing for no longer than 2 years' duration and be approved by a majority vote of the shareholders. The contract must be reapproved annually by the fund's board of directors or by a majority vote of the shareholders, and must provide for termination of the investment advisor at any time by either the board or a majority vote of the shareholders with 60 days' notice. The investment advisor gets paid most generally a percentage of assets managed. So their compensation must be derived according to a formula that is clearly set forth in the fund's prospectus. So the typical fee, 0.5 to 1% of average net assets, although the fee will vary from fund to fund, depends upon what kind of fund it is. The more actively managed funds always have a higher investment advisory fee. The higher the investment advisory fee, the higher the expense ratio for the fund will be. While the fee is based upon average net assets on an annual basis, it is normally paid quarterly. Any changes in compensation paid to the advisor require approval of a majority of the shareholders and the board of directors. This fee is usually the largest expense of the fund. It is paid out of operating income. So let me kind of tell you a story here. So here we have the mutual fund, the board of directors, and then we have the portfolio. And I'll stick with the balanced fund. How much of the board can be interested? We said 60% interested. The largest expense of the fund is the investment advisory fee. So the IA, investment advisor. Percentage of assets under management. So we've said all that. In a balanced fund, we have some stocks, and some bonds. Who safeguards the assets in the portfolio? The custodian. So all of these securities are registered to the custodian. Stocks pay at most quarterly dividends. Bonds pay semi-annual interest. The dividend income plus the interest income go together and make up what is called the gross investment income of the fund. Out of the fund's gross investment income, we subtract operating expenses. Out of the fund's gross investment income, we subtract operating expenses. What's the largest operating expense? The investment advisory fee. Granted, if it's an index fund, it's possible that it's not the largest expense of the fund because they have low management fees. So out of gross investment income, we subtract the investment advisory fee. There's other fees that we're going to get to. Once we subtract all of the operating expenses of the fund, we're left with the fund's net investment income. It's out of the fund's net investment income that the fund pays dividends. So a mutual fund may pay dividends to the mutual fund shareholders at most, how often? Quarterly, at most quarterly. So if the fund has a high operating expense ratio, I said this earlier, but hopefully now it'll make more sense. The higher the operating expenses, the lower the yield. The lower the operating expenses, the higher the yield. Yield is basically dividends divided by the current market price of the fund. The custodian gets paid a fee for safeguarding the assets in the fund. So the custodian gets paid this fee, custodian. All of the shares, stocks, and bonds registered to the custodian. We already said that. So the custodian fee is an operating expense of the fund. All mutual funds must have a transfer agent. So the transfer agent's job, it's usually a commercial bank, is to issue new shares. Open-end funds are always selling new shares, and redeem the shares when the shareholder wants to redeem them. So basically you can think about it like the transfer agent takes them, rips them up, and throws them in the garbage, because nobody else can ever own that investor's open-end mutual fund shares. So the transfer agent sends out customer confirmations, sends out fund distributions, so the 1099s, dividend distributions, capital gain distributions. The transfer agent performs the record keeping for the fund, keeps track of who owns fund shares. So sometimes it's the same company that acts as custodian that acts as transfer agent, but the duties of the custodian transfer agent are different, so be careful there. The fund pays the transfer agent a fee, so transfer agent issues and redeems shares. Transfer agent distributes capital gains and dividends, sends out the 1099. They are also an operating expense of the fund. The underwriter, the sponsor, the distributor of the fund. So when we are talking about an open-end fund, some funds charge a load and some funds do not. So we have loads and we have no loads. So another word for load is sales charge. No load funds have no sales charge, just like it sounds. If it's a load fund, the board of directors will appoint an underwriter, we call them a sponsor or distributor, to sell fund shares to the public. The open-end investment company will sell its shares to the underwriter at the current net asset value, but only as the underwriter needs the shares to fill customer orders. It's a best efforts type of underwriting. How does the underwriter make money? So the underwriter got the shares at NAV, they tack on a sales charge, and they sell their shares at what is called the ask price. So when we have a load fund, NAV per share plus the load equals the ask. The client buys at the ask, buys at ask. When the client redeems their shares, they redeem at NAV per share. So the client buys at the ask. This is a front-loaded sales charge in this example. Now, FINRA has a rule, it used to be an NASD rule, that says that the maximum sales charge allowed on this front-loaded fund is 8.5% of the ask. The maximum sales charge allowed is 8.5% of the ask. For example, let's say that the ask is $10. The maximum sales charge is 85 cents, 8.5% of 10. The NAV per share would be $9.15. So the underwriter buys the share at $9.15 and then sells the share to the investor at $10, making this load, this spread, this commission. The 85 cents goes to pay the sales charge, and it also covers advertising expenses associated with the fund. So the maximum sales charge allowed under FINRA rules is 8.5% of the ask. So the ask price already includes the sales charge. This is an open-end fund, of course. If it was a closed-end fund or an exchange-traded fund, those trade in the secondary market. When you buy one of those shares, you'd buy it at the ask plus a commission. So that's a pretty big difference between an open-end fund versus a closed-end or an exchange-traded fund. Open-end funds, the ask includes the commission. Closed-end funds, exchange-traded funds, ask plus a commission. When they want to redeem, they're going to get the bid and be charged a commission again. So when you have an exchange-traded fund or a closed-end fund, it's highly probable that you're paying a commission both on the buy side and on the sell side. Where if it's a front-loaded open-end mutual fund, you only pay the sales charge when you buy the share. The ask price includes the sales charge. Mutual funds are required to value their assets in their portfolio a minimum of once every business day. We talked about that at the close of business of the New York Stock Exchange. Some funds will do it more frequently than that, once at noon and once at the close of business of the New York Stock Exchange, and that's perfectly fine, but they don't have to. Whenever an investor is buying an open-end fund share or redeeming their share, they always get the price next determined. Imagine if you could get the price last determined, right? On a really good day when the market closed up 350 points, we'd all redeem our shares. We can't do that. I mean, we could place an order to redeem our shares, but we wouldn't know the price until they next determined what price. So forward pricing. We talked about this idea that all of these assets within the portfolio, they are valued at their current market value. So the stocks and the bonds are valued at their current market value. So that the value of everything in the portfolio, that is total net asset value. If you know the number of shares outstanding, so total NAV divided by number of outstanding shares, what did that give you? Do you remember? NAV per share. NAV per share. Now, what's going to cause your NAV per share to go up? Appreciation of the assets in the portfolio. What's going to cause your NAV per share to go down? Depreciation of assets in the portfolio. So it's the expansion and contraction of the portfolio, the balloon, if you will, that causes your mutual fund's share price to change. The test likes this concept of what are called net redemptions and net purchases. So a net redemption occurs when more people are redeeming their shares than are currently purchasing. And a net purchase occurs, sometimes mutual funds get popular and everybody wants to put their money into it, so more people are putting money in than are taking money out. So if more people are putting money in than are taking money out, the balloon's going to get bigger, right? But what's going to happen to your NAV per share? Nothing. Why? Because now there's more shares. So same thing with a net redemption. So sometimes it becomes an unpopular fund and everybody gets out of it. So the portfolio shrunk. What happens to your NAV per share? Nothing. Why? There's less shares outstanding. So they sometimes like that concept on the test. Let me give you an example. Let's say we have an NAV, total NAV of $500, the smallest mutual fund in the world. We have 5 shares outstanding. So NAV per share must be $100. NAV per share, $100. So let's say that 2 shares are redeemed. 2 shares are redeemed. Now how many shares do we have outstanding? 3. The 2 shares are redeemed at NAV per share, so they got $200, which leaves $300 for total NAV. What happened to NAV per share? Nothing. It stayed the same. So that was just a short story. It usually helps to illustrate the principle if I give you a little bit of math behind it. Sales charges and pricing. We already learned that the maximum sales charge allowed under FINRA rules is 8.5% of the ask price. So that NAV per share plus the sales charge equals the ask price, equals the ask. And the maximum sales charge allowed, 8.5% of the ask. The test wants you to feel comfortable with NAV per share is the same as the redemption price. NAV per share is also the same as the fund's bid price. Sometimes they'll call the sales charge a commission. Redemption price plus the commission. So sales charge and commission is the same thing. Sometimes they'll call the sales charge the spread. So those are all synonyms. Sometimes we call the ask price the public offering price. And sometimes we just call it the offering price. So just feel comfortable no matter which of these terms the test uses, that you understand you buy at the most, you pay the ask, the POP, or the offering price. When you redeem, you get the least, NAV per share, redemption price, or bid. Bid plus sales charge equals the ask. Most it can be is 8.5% of the ask. So the sales load is a percentage of the public offering price, not a percentage of the NAV. Every once in a while, they'll ask you a question like this. If a fund's NAV is $9.50, so NAV per share, $9.50, and their sales charge is 5%. What is the offering price? Okay, so be very careful. Remember that the sales charge is a percentage of the ask, not a percentage of the $9.50. They give you a basic non-programmable calculator down at the testing company. Use it. You can't just take $9.50 times 5% because that will give you the wrong answer. You've got to take the $9.50, the NAV per share, divide it by the complement of the sales charge. So 100% minus 5%, the complement of the sales charge is 0.95. So $9.50, use your calculator. I know it sounds really hokey. Just do it. It's so funny how many times students, when they actually use a calculator, don't know what they're doing. It's funny. So 950 divided by 0.95 is basically what we're doing. So this would be the formula. If they give you NAV in a sales charge, you take NAV divided by 100% minus the sales charge. So in this case, we've got 950 divided by 0.95, which gives us an ask of 10. And then I always double check my math because I'm a math nerd. So 5% of 950 is 50 cents. 950 plus 50 cents equals 10. Yes, I got it right. So I always double check. So be really careful. Just remember that the sales charge is expressed as a percentage of the ask, not as a percentage of the bid. The examples so far that I've used have illustrated a front-loaded sales charge. Sometimes the sales charge is a back-end load. Back-end load we sometimes call a contingent deferred sales charge. Now, we're still going to have the rule, the maximum sales charge that it can be is 8.5% of the ask. Anytime an investor buys a mutual fund that has a contingent deferred sales charge, it must say that on the confirmation. So they're basically buying at bid equals ask, and then you'd want to read the fund's prospectus to determine. A lot of times when a fund has a back-end load, if you hold the shares long enough, you won't have a sales charge upon redemption to encourage holding the shares for a long period of time. Really, open-end mutual funds are not designed for short-term trading. So contingent deferred sales charge, how long you'd have to hold them for it to become something that wouldn't have a sales charge upon redemption, you'd really have to read the fund. They do usually reduce to 0 depending upon the holding period. The maximum it can be, 8.5%, must be disclosed in the prospectus. The contingent deferred sales charge is based upon NAV at purchase or NAV at redemption, whichever is less. That's an interesting rule. So when you have a back-end load, the sales charge is based on NAV at purchase. So basically what this is saying is that if the portfolio has appreciated, you do not pay a sales charge on the appreciation. So sales charge is based upon NAV at purchase or redemption, whichever is less. You do not pay a sales charge on appreciation, whichever is less. Must be disclosed, of course, like I said, on the confirmation. So there was a lot of years ago, a lot of awful articles written about loads. So funds that had loads, maybe they switched and became back-end loads, or maybe they just got rid of the load altogether. So that when you have bid equals ask, this is either a fund with a contingent deferred sales charge, which is not a no load, or in fact it is a no load. So there are lots of no load funds out there. Just because a fund doesn't have a load doesn't mean it's a good fund. So I think it's important that investors realize that. When you buy a fund with a sales charge, you pay that one time. What happens a lot of times with no load funds, not always, however, this is generally speaking though. So what the funds started to do is they found that when they didn't charge a load, they didn't have any place to pay for their advertising expenses related to selling those shares. So they came up with an asset-based operating expense. And then the SEC figured out what was going on and made up what is called SEC Rule 12b-1. SEC Rule 12b-1. So there are what are called 12b-1 fees. So what a 12b-1 fee basically is it's an asset-based operating expense that reduces the amount of the dividend for the shareholder, the amount of the dividend. So it affects the investor's yield. It's an asset-based operating expense that reduces the amount of the dividend. It is used to pay for sales and advertising expenses. Okay, wait a second. Let's make sure we're clear about something. Bid plus sales charge equals the ask. Bid plus sales charge equals the ask. So if you pay $10 and there's an 85-cent sales charge, $9.15 ultimately goes into the fund. How many times do you have this sales charge? Just once, when you originally buy the share. So $9.15 goes in to buy your share, basically. You got to keep your money in there long enough for the portfolio to appreciate, be worth 10. But you only pay the sales charge one time. So if a fund has no load, but instead has a 12b-1 fee, this 12b-1 fee, so remember the chart where we made gross investment income, that was dividends and interest from the bonds and the stocks, and we subtracted out operating expenses. And we said the investment advisory fee was the largest expense of the fund. We said there was a custodian fee, there's a transfer agent fee. And if the fund has a 12b-1 fee, that will be an operating expense and it will reduce the fund's net investment income. Is the commission, is the load an operating expense of the fund? Never. Is the 12b-1 fee an operating expense of the fund? Yes. If you have a share with a 12b-1 fee, every year that you own that share, you will receive less in dividends than you would have received had there not been a 12b-1 fee. So we call this a trailer fee. It's like a hidden sales charge, kind of. It affects your yield for however long you own those shares. So 12b-1 fees can really affect the investor's return. They have the effect of increasing operating expenses, which lowers the dividends. The lower the dividend, the lower the yield. You pay a load once, you have a 12B1 fee every single year. So maybe no load, no 12B1 fee is the best thing that you can get. I don't know. There are some of those out there. If a mutual fund charges a 12B1 fee, they must have a 12B1 plan. The plan must be approved initially and reapproved at least annually by a majority vote of the outstanding shareholders, the board of directors, and those that are not interested persons of the investment company. To imply that a fund with a deferred sales charge is a no-load is a violation of FINRA rules. If it has a deferred sales charge, it is not a no-load. To imply that a fund with a 12B1 fee of more than 1/4% of average net assets is a no-load is also a violation of FINRA rules. So if the 12B1 fee is more than 1/4% of net assets, then it cannot call itself a no-load. Not a no-load. So basically, the most they can charge is 1/4% of net assets. If it's more than that, then they cannot call themselves a no-load. Now, after years of things kind of changing within the industry, so first we talked about how loads became bad, and then kind of, 12B1 fees aren't so good either. So mutual funds came up with a solution. What did they do? They decided that, let's say that this is the growth fund. We are going to give the investor choices of different classes of mutual funds. Now, everybody's share is equal. Mutuality says nobody's better than anybody else. What is different with these classes is what are the sales charges and what are the operating expenses. Class A shares, Class B shares, and Class C shares. Now, this isn't by law. It doesn't have to be this way. This is just sort of how the industry has evolved over the years. So as a general rule, these things are true. And then sometimes they make you answer a question on the test where maybe it's not exactly what I would say out in the real world, but just follow the rules for the purposes of the test that I describe here. So they're different with sales charges, they're different with operating expenses. Class A shares are front-loaded. Class A shares are front-loaded. They have low to no 12B1 fees. Low to no 12B1 fees. They have the highest yield because they have the lowest operating expenses. They also most commonly will offer schedules of breakpoints. So for large lump sum investments, you will get a reduced front-loaded sales charge. So Class A shares are best for people who are investing a lot of money all at once. Class B shares are contingent deferred sales charges, so back and load. They have the highest 12B1 fee. Thus, they have the lowest yield. They will, at some point, as described in the prospectus, convert to an A share after a period of time. For the purposes of the test, if you have an investor that's going to invest a little bit on a regular basis, Class B shares, long-term holding period, Class B shares are the best. This is the area in the real world. There's been a lot of funds that don't even offer Class B shares anymore because a lot of times we can prove that a Class A share is better than a Class B share, and there was a lot of litigation and millions of dollars paid out related to people that had been improperly advised to buy Class B shares. So in the real world, be careful. But on the test, they like this idea. A lot of money to invest all at once, Class A. A little bit over time, going to hold a long time. Class B is perfectly fine for the purposes of the test. And then there's Class C shares. I like to say that they're for people who can't decide otherwise. Class B shares convert to A shares, but Class C shares don't. So Class C shares may be front or back-end loaded. They have a middle 12B1 fee, and they never convert to A shares. And it's possible your fund has different classes of fund shares as well, beyond the scope of the test. So these are the 3 to know for your exam.